Good afternoon, everyone, and thanks for joining us. I'd like to welcome you to this week's Monday Minute Live Chat hosted by the Canadian Leadership Congress. And today we're addressing ESG, what lies ahead for asset owners in 2022 on the ESG front, and the importance of knowing what you own. And to speak about this, I'd like to welcome Mary Jane McQuillen, Managing Director, Portfolio Manager, Head of ESG Investment with ClearBridge Investments, a Franklin Templeton company. Welcome.
Thank you very much, Carolyn. Very nice to be here.
Great. Well, let's start off by talking about what your conversations with asset owners have been like on the ESG and sustainable investing front, and what are the main questions you're getting?
Yeah, it's lots of different areas, and depending on the geography of the asset owner, it could vary slightly as well. And so one of the most common topics in the past 12 months has probably been climate risk and climate change overall. And related to that, Net Zero Asset Managers Initiative, as well as the Net Zero Asset Owners Alliance, and lots of discussion on climate. Also, lots of discussion and questions around human capital management, in particular in a post-COVID world, how employers are treating their workers and employees. And along those lines, what sort of diversity, equality, and inclusion policies are there at these companies, and are changes happening is a big question that keeps coming up, particularly in the US. And then also around impact. In the old days, asset owners were just seeking performance, but increasingly as they're taking performance in a sense for granted, expecting that performance to be delivered, they are now asking what else can happen. And so with impact, that is still an early stage conversation of how to measure it, what defines impact, and how much impact are you expecting from your investments as a long-term investor. And when we think about performance, that's something that just is always going to come up, regardless of whether it's climate or diversity and inclusion. Performance will still keep coming up. And what's interesting is that as we speak to asset owners, increasingly their beneficiaries or their constituents are asking about these ESG issues. So it's coming up from their plan sponsors as well as from the beneficiaries. So pretty much those areas.
Yeah, those are some big picture themes here. You're obviously having very robust conversations. I want to pick up on your comments around post-pandemic human capital. How has COVID changed maybe your view of ESG or how it's perceived by asset owners? And why human capital management in that? I'd love to hear more about that.
Sure. So as investors in active equities, again, we're not investing in the entire benchmark. We're investing in those companies where we have high conviction with a long-term view. It is hard to ignore the importance of the workforce and the relevance of good policies, retention, as well as talent management. And where human capital management comes in a post-COVID world is where it's been very enlightening to speak with our companies. We engage with them very regularly. We speak to 1,000 companies a year about all sorts of ESG issues. But COVID in particular has come up from, I would say, March of 2020 all the way through still today, and we expect to going forward. So over 2 years of discussions around how companies are preparing to avoid the next pandemic and what sort of risk management do they have in place? How are they ensuring that workers who have decided to leave the workforce for a variety of reasons, healthcare or for childcare, how to ensure that they can get those workers back, and how to balance work from home, particularly office workers, with the new environment as compared to going to the office every single day. And benefits are important. We want to still see our companies providing support, and the incentive and the mental health and wellness that is really important in the relationship between employer and employee. It's so stressful. It's been so stressful for a lot of employees, particularly those who may be considered frontline or on the floor. So we own a number of companies that have a very large workforce that were in retail operations. And so how do they ensure that they are safe? Or we've also owned companies that have chosen organic and natural routes because they believe that that is something that's going to contribute to a more sustainable future and a healthier future for consumers. And so those are some areas of human capital management.
Well, and extremely relevant for our listeners today as well, right? Pension funds, and it's the one of the great benefits offered to employees. Okay, I'd like to talk a little bit about some of the opportunities you see right now, whether it's from the UN Sustainable Development Goals or specific sectors or companies. What are you looking at?
I tend to manage a portfolio diversified approach. And so I'm always looking at all sectors and trying to identify companies that have attractive financial characteristics, attractive valuation, strong balance sheets, good fundamentals, good capital allocation policies. But I'm also looking for companies that have a high sustainability profile. And these are companies that are in new industries, whether it's not that this is that new, but renewable energy and renewable power, clean power, as well as old line industries such as materials and something as common as cans and aluminum packaging. So we find companies, we own a company, for example, that is a world leader in aluminum packaging. They are trying to displace single-use plastic bottles. And as we may know, only about 9% of single-use plastic is recycled, and it depends by country and the municipality. But for aluminum, the value of aluminum is so much higher that the incentive to recycle it, particularly in countries like Brazil, it's like 90% recycle rate, where in the US, I think it's more like 60 or 55% recycle rate. Because it can be recycled infinitely, it's very attractive for a sustainable investor because we don't need to take new raw material. We can actually continue to use the existing material, the aluminum, for their packaging. And there are lots of opportunities in there financially as well, because as consumers are switching away from plastic bottles, single use, to aluminum cans, the opportunity for different specialty sizes for aluminum cups. We're thinking about stadiums and all those cups that people drink out of. They can be from aluminum and then easily recycled, as well as small cans, large cans, narrow cans, and those actually demand a very high margin.
That's great. When it comes to ESG and opportunities, how do you look at, say, the S and the G in the ESG equation? We've talked a lot about, recycling and more sustainable business practices in terms of resources in the environment. Are there specific opportunities or ways of looking at, say, societal factors, or, well, of course, governance, which I guess underpins a lot of your decision making? But tell me
Absolutely.
about that.
Yeah, sure. I mean, at the end of the day, all companies are pretty much run by people. Even if there's high automation, they still have people involved, and they need to be run by someone, again, more people. So the S, whether it's the workforce or whether it's senior management or it's the communities in which the companies have a license to operate, the S is very important. And I think more sustainability investors are taking a closer look at the S rather than just focusing on the E. And the S is a bit nuanced because you're dealing with people and policies. You're dealing with different types of employees. You're dealing with different types of employers as well. And then, like, supply chain is something is, been around for quite a long time. Supply chain management is an area that many of our companies have had a long history of managing well, but there are a lot of supply chains that are not managed well. So there's still more work to be done there. And in terms of governance, who is running the company? What type of decisions? Do they have the right people in place? So if we take the board of directors, for example, we tend to favor companies that have independent board directors. We don't necessarily want the family members or the friends all serving on the board. We want qualified board directors, those who will add something to the decision making and provide a need or skill set that's not currently filled on the board. And we'd like a diverse board, so not all the same type of thinking. So it's not just diversity in terms of race, ethnicity, or gender. It's also diversity in terms of where they come from and how they think about different issues. And that could also represent age differences as well. And then executive compensation. It's important for us that our management teams, the CEO, the C-suite, the named executive officers are paid reasonably and properly. You want to keep that talent, so you don't want to underpay them, but then you also don't want to have them overpay themselves unnecessarily. What was interesting out of COVID is there, because a number of companies suffered financially, perhaps they had supply chain constraints, they had pricing pressure, they had commodity costs and inflation, and they had transportation and logistics challenges. So they weren't able to be as profitable, a number of companies. So if they had targets set with their comp, they might have felt like they were going to get underpaid or lose something. So they put in some COVID, I'm trying to remember what it was called, but it was like a COVID factor, but they were able to kind of put back more in their comp because of COVID. In some cases, it made some sense. In other cases, it was like an extra bonus. And we wanted to kind of see the difference and not just automatically approve every management proposal for such types of comp. So I think that's important, is to align management incentives with shareholder interests, but also align management incentives increasing with ESG criteria. So one of the, I would say, fastest growing discussion points or most common discussion points that we're running to on governance is, does the CEO include ESG criteria in his or her compensation? Is it just on financial targets, or is it on diversity and inclusion targets that the company might set, or climate targets, or safety targets? And that's not that uncommon. And when you think about the different sectors of where ESG compensation and whether it's related to gender or related to climate, the most mature in terms of saturation of CEOs who have included ESG in their comp is actually the energy sector. And I'm not entirely surprised by that, because the energy sector for a long time had explicitly included health and safety and as part of their comp, which is critical. You can't have people in unsafe situations or people having lots of accidents, which also cause disruptions as well. And so that has been pretty high, like I think it was like 90% of the energy sector. And then as you go through the different gig sectors, it goes down from there. But we're seeing that many of the other sectors, non-energy, are acknowledging that ESG should be and will be part of their incentive comp. So I think that's kind of an interesting development.
That's great. And those are really helpful questions around engagement as well. But those are really interesting areas to focus on. Greenwashing, right? It's something asset owners talk about. How can we avoid it? And how prevalent is it?
So greenwashing, okay, so there are different types of greenwashing, you could say. There is greenwashing, and probably a little bit more has been around for longer, is concerns around greenwashing by corporations or by companies who have very beautiful sustainability reports and very nice websites that talk about saving the future and what their contributions are. And many of the companies, particularly ones that we look at, are legitimately, based on our due diligence, applying a sustainable practice and leadership in that space. But there are other companies that, as you dig a little deeper, you find that it's kind of superficial and they're not as sustainable as you might have initially thought based on the reports and the website. Along those lines, now there's more scrutiny on greenwashing by asset managers or funds. And that's a concern that has elevated to the point in Europe, for example, where the EU Commission has discussed SFDR, Sustainable Finance Disclosure Regulation, and EU taxonomy. And the thinking behind that was to help consumers or investors be able to better understand the differences between different managers' approach who use words like ES or terms like ESG or sustainability or impact, so that the disclosure requires managers to set a standard and either promote ESG and sustainability or try to make an impact. But the thinking behind that regulation was to help to distinguish and discern amongst the different funds that all are starting to look very similar. And as a practitioner at a firm that's got over 30 years of ESG investing, I've got over 25 years. When I think of 10, 15, 20 years ago, the marketplace was pretty scarce to find an ESG fund. Today, in the past 3 years alone, the number of new ESG funds have been doubling, quadrupling. According to, I think it was Goldman, the number of rebranded funds are now higher than the number of new funds. So taking an existing fund that never had any ESG language in the prospectus or ESG claims are now being rebranded as ESG funds. And it's to participate in a marketplace where the demand for ESG funds has gone up quite a bit. And that's in the US and Europe. The largest demand is still in Europe, but there's growing demand in the US and North America. I'm sorry, North America. I keep saying the US. I'm like, no, I have to say North America.
Okay.
I'm thinking Canada, but I just didn't say it. I'm sorry.
That's
US
okay.
and Canada, and actually all over the world, the awareness has gone up quite a bit. And so the number of products has really proliferated. And if you look at them as a practitioner, like they all start sounding the same. They all have claims of being an ESG for 20, 50. One firm suddenly said 75 years, which that was interesting. And is anyone regulating this? Is anyone really testing this? And so what we say to a lot of asset owners who ask us, well, how do we decipher? How do we talk to our consultant to help us understand what the differences are? And I'd say there are a couple of rules of thumb. One is just like any other investment, particularly for public funds or large institutional asset owners, you really want to look under the hood and understand the quality of the management team. You want to understand the performance track record. Have they been successful in ESG investing, or have they not been so successful? And how long have they been doing this? Has it been, 30 years, or has it been 2 years? And who's picking the stocks? Who's running the money? And what are their qualifications? And what sort of infrastructure is the firm supporting? So is the firm only supporting that one fund and everything about ESG and sustainability is focused on that one fund? Or is the firm saying this is a firm-wide commitment? And if we think ESG makes sense in our investment process for all of our clients, then we should do it across the firm. And if we think this is a good practice as an investment practitioner, then we should do it across the firm. So it's a type of philosophy and approach that when you do some due diligence and look a little bit more closely at the manager, the claims, the history, the tenure experience, and the infrastructure, it can give you a sense. And then suddenly, the crowding starts to kind of dissipate, and you see a handful, and then you see everybody else.
Yeah, and I want to pick up on that a little bit on the everything else. I really enjoyed your 2022 outlook, and it raised a lot of themes and looked at ESG a little bit differently. And I found it interesting. And one of the pieces you raised in it is this idea of knowing what you own, which you called sort of the improver company. Can you explain that a little bit more for me and talk about its relevance today?
Sure. So when we think of ESG investing in terms of listed equities as an example, which is the oldest asset class where ESG has a long track record, and then all other asset classes are participating now as well. But equities are the oldest. And then within equities, you have active and passive. And active management according to Morningstar, for ESG equities or funds is by far the largest, 95% compared to passive as of recently. And this has been the trend over time. And what's interesting about active management is that there needs to be a deliberate commitment to engagement. So it's not just using screening tools or third-party ESG raters or trying to find the best-in-class companies, because even if you find best-in-class companies, or as we call them, sustainability leaders, it doesn't mean that there isn't more room for improvement. And it doesn't mean that you shouldn't continue to engage them, because as we move into the future, new issues come up, changes happen, CEOs leave, new CEOs come in, and you want to make sure that what you thought you were owning in the beginning and over time continues to maintain a high level of conviction and is your view of how you can manage risk and the position size, for example, with that company, that stock. So with improvers, we've noticed that that's a newer term that's come into the marketplace. We don't necessarily see it all as the same. So we've seen some managers who have a certain style, perhaps I'm not picking on value managers, but perhaps it could be a value style. They will say, oh, let's invest in improver companies because we will invest in companies that are laggards or may seem like the worst of the worst, but if we invest in them and we work with them, then they might improve. And that's a good thing, right? And I would say yes and no. It's a good thing if the managers are committed to doing that, because if the investor's intention is to invest in highly sustainable companies or companies that are moving in that direction, if the manager is not committed to do that through engagement, for example, then it's not quite leading, they're not quite standing up to what they were claiming. So for example, I have a colleague who manages a value strategy, but he is absolutely committed to getting his companies to net zero. And he is investing in areas that could be energy, industrials, utilities, materials. And if we're thinking of climate risk and carbon intensity and a decarbonization pathway forward, I do, and I'm only mentioning my colleague because he's an example I know very well. He is adamantly speaking to the CEOs on a regular basis, saying this is the future. You need to set targets and you need to put yourself into science-based target initiative, and you need to work with us to show us your progress over time. And he's taking the long game in the sense that he's not expecting them to change in the next 3 years or the next 5 years. He's going to stick with them and try to make sure that they change and improve in this example of climate risk for the long run. And so I think you can have improver companies where managers are legitimately committed to improving them with a benchmark in their minds of what the targets are. And if they don't see those improvements, what's the escalation policy? And then there are improvers for companies that are best in class. So that's like a third category. So there's like the laggards, there are those that are truly committed to change, and then there's the best in class. And we invest in a lot of those companies where they're doing a great job, but could they do more? And again, that's through engagement. And engagement is so important in our view as equity owners, because management, from our experience, management needs to hear from investors. A lot of changes that we've seen in terms of practice and policy of companies over the years have been a result, and they've told us that if investors didn't bring this to our attention, we may not have been able to take this to the board of directors. We may not have been able to put as much resource or energy behind this. And that's kind of exciting for investors that they can partake. We don't want to run the company. We're not activists. We want to let our management teams know that we're seriously thinking about the long term, and sustainability is a big part of that.
Yeah, I want to pick up on that a little bit because, of course, oil and the energy sector in general are really huge staples of the Canadian economy. And as we move to this idea of a net zero future, what does it look like for Canada, right? And how does it look on the engagement front? What kind of targets can you set for some of these companies?
Yeah, it's a great question because it's not an easy answer and it's not an easy pathway. So interestingly, a number of the large oil majors have stepped forward and said they're going to commit to net zero. But then you would have some skeptics on the side say, well, how can they commit to net zero? Isn't that essentially putting themselves out of business? And then you would have other related industries. So for example, the auto industry, one of the larger contributors to carbon emissions would be through transportation and autos, and how can they set targets? So we've seen like two major US automakers make commitments toward net zero. I'm still trying to figure out exactly what the commitments are in year over year, but one way, a big way that they're planning to get there is to essentially put the internal combustion engine out of business and to convert everything into EVs. And that's one pathway that we've seen a related industry address or tackle how to decarbonize their products and services through scope 1 and scope 2 emissions. The big question is scope 3 emissions, and that's what happens after you in supply chain. So it happens with you make products, it's like what happens after you sell it and what sort of emissions are going to come out of that. And then what about your supply chains and what sort of emissions do they have that do you count them or not count them? There's a lot of carbon accounting discussion going on in this space right now too. But for oil and gas, practically speaking, it's an essential part of the global economy. There are a lot of investors who, call for divestment or call for escalation policies. But at this time, practically speaking, as much as for myself, my colleagues and I, we invest in a lot of renewable energy, it's still not enough to address the energy needs. And there's still challenges in storage. And if you don't, you can have renewable power, but you still need to be able to store it when certain types of renewable power have intermittency issues. So with oil and gas, what we're seeing companies trying to do, candidly, I don't invest in a lot of oil and gas or Canadian oil and gas, but we get the sense through engagement that they're definitely hearing, like, this is coming down the pike, either through regulatory changes and requirements or consumer preferences. People in, for example, California are installing solar rooftop left and right. It's a very big movement right now, and has been. And through tax credits and subsidies, the expectation is that more and more people are going to switch over. So we think the energy companies have a role to play. They're extremely important to the continuation of all the other companies in the world. You can't have, everything you do, of course, whether it's fertilizer or whether it's, plastics, it's going to come back to that resource. But can they be transitioning toward, for example, I'll give you a concrete example. My colleagues who have some midstream companies in their portfolio have been actively engaging the companies to commit to reducing fugitive methane. And that's a huge emission and contributor to global warming. And it can, when you have thousands of miles of pipeline for transportation of oil and gas and there are leaks, what can they do to address that? They don't want to perhaps stop the transportation of oil and gas, particularly around the whole world and from different parts crossing different borders, but they can at least start stopping the fugitive emissions, which is huge. And they can make commitments for safety around the pipelines. And that's an example of where my colleagues have seen progress in the company's responsiveness and willingness to investigate and explore what can they do. Because the bottom line with net zero or any of the climate initiatives like Carbon Disclosure Project, TCFD, the Task Force for Climate-Related Financial Disclosure, or the Investor Network on Climate Risk, or the Climate Action 100+, you can go on, is that what everybody wants is for people to start. And people meaning people at companies, management teams to start.
Yeah, and there's a lot of nuance in these discussions. Clearly, how helpful are benchmarks in all this?
So benchmarks for sustainability in general, benchmarks can be a little tricky, particularly in the US, where we have very large concentrated holdings, companies, or benchmark constituents that can be a very large part of the index. And so for sustainable investors, they might say, well, if we took communication services or IT, we all know the big companies that are in the top 5. And if you don't own those companies, then when you're being measured against the benchmark, it makes it a little bit difficult. If it goes up, those companies go up. It also is fine if they go down, then you don't participate in that. But some of those big companies have very complex sustainability challenges. And I don't know if there's any clean company. Every company has something that can be addressed or improved. And so what it comes down to from our perspective is that you really have to do a lot of work and research on knowing what you own of those companies if you're going to take a big benchmark constituent and include it in your portfolio, and then commit to engage. And many investors think that you can't engage these very large companies. And our experience has been, yes, you can, and they want to hear from you and they can make change. So when we think of sustainable investing, particularly sustainable leadership, we think of products and services. So what types of products and services are contributing, again, meeting the financial excellence criteria that needs to be there first. And what sort of operations. So the scale of change that can happen when you invest in some very big companies, if you have the ability to engage them and command their attention to the extent that they want to hear what you have to say because you're a long-term investor, and you're talking to them as a fundamental investor as well as a sustainability investor, the aptitude and the openness for change is quite remarkable. So if we think over time, very big paradigm shifts, transitions in material, I think of beverage companies that used to be 100% virgin plastic have moved now into using as much recycled plastic as possible, or moving over to aluminum, as we alluded to earlier. But we also see companies that, for example, a very large component of the benchmark is the second largest employer in the world. And if they make changes to hourly wages, to health benefits, to safe health and safety policies, that makes a huge change in a lot of people's lives. And so the scale of that type of change through engagement is meaningful and can affect make a lot of impact in our view. There are other companies that are still going to be challenging, and you might not be able to get them to change. And having been a long investor in this space, sometimes it takes a change in management, and that's, you don't want to have to wait till that point, but sometimes that's what it takes. And then you start using your proxy voting and you escalate in that way if you become an owner.
That's great. Well, look, I've really enjoyed our discussion. Thanks so much for your comments, Mary Jane. It's been great. And that wraps our Monday Minute for this week. Don't forget to send us your questions and we'll get right back to you with our speaker's response. And we've got a lot of exciting content and great interviews lined up this year that you won't want to miss. So be sure to hit the like and subscribe buttons below and visit us at leadershipcongress.ca to get our informative CLC newsletter. Thanks, everyone, for joining us. Thank you, Mary Jane.
Thank you.
And we'll see you next time.